All right, good morning. Welcome to QuantBox Live, where we get our global macro on and uncover the best fundamental opportunities across the global markets. You want sentiment? Got it. You want inflation? Got it. Employment? Got it. GDP, technical trends? Got it. Got it. Hmm. How about some institutional positioning or retail positioning? How about using tools to observe black holes? How do you observe a black hole if it doesn't give off light? Yeah, you have to indirectly observe it. And that's how we uncover the intrinsic trend. So we're a bunch of smarty pantses here. We make very wise investment decisions and we do work that where no one has worked before. Above and beyond, that's what our average day is. So very cool. So yes, YouTubers, if you're watching this on QuantBox, stop trading like an amateur. It's embarrassing. Join QuantBox, take the trial. It's $8. We'll knock your socks off. Imagine, for example, this is how you organized your trading. Right now, you're a random mess, a smear on the chart. Well, if you use QuantBox, everything is clean and organized. Yeah. So, anywho, let's get on with it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Let's go directly into the pro. Let's go pro. QBox. QBox. Look at the yields. Holy smokes. Monster day yesterday. Very cool. Very cool move. Very favorable. If you happen to own a 20-year note, I'm not saying I do, but I might. And that makes me very happy if I did. So that's good. Yields coming down. Oil struggling again. But look, we're at 78. Like, interesting, huh? S&P all-time high, never hit 54 before. Euro dollar back to 108. Bitcoin down a bit. Skipping ahead a little bit, look at the options traders. Let me zip over here. Come on. There we go. Look at the options traders yesterday. What does that mean? They're buying a boatload of calls. What does that mean? They think the stock market's going to go up. Risk on. Okay, there's more calls than puts. So, holy smokes, and look how dramatic it is relative to what's been going on. Game on, and it's got to be that CPI, huh? The lower CPI. And then, the hot money guys. Yeah, all right. Yeah, it's risk on. It's not as dramatic. That's all. Yeah, Swissy. Yeah. All right, let's go through. Where are we? Risk on, risk on, risk on. That's the first time in a while, huh? It's the first time in a while, risk on. Let's take a look at the weekly. The last 7 days, yields are flat, zero. Gold is down a little bit. I score that good. Yen down, good. Dollar strong, week over week. That's not good. S&P 500 up, that's good. And VIX is down a little bit, but not dramatically. That's neither here nor there. So we get a little 2 out of that. But that's the first time we've seen it across the board, huh? In a long time. So the market is bullish. Treasury traders, right? The bond market's bullish. right? Gold market's bullish. Yen market's bullish. I mean, not for yen, but meaning overall direction here. Dollar, like all these, this is starting to really come together. Here's a little zoom in if you want to see it closer. Definitely risk on the 2 year. Yields currently at 4.75. Okay. It was as high as pretty close to 5.0. And then, in fact, we hit 5.0. Lower low, lower high, lower low, lower high. All right. So that could be a risk on. So in this case, the hot money, which is just short-term money, this is just 2 year treasuries, right? They have nothing to do with the put call ratio. It's nothing even related. And these guys say risk on, and then we look at the put call ratio, which is the options trading guys, and they're risk on. Sweet. And those two constituencies don't really talk to each other, but they're doing the same thing. Cool. So how are we doing over here? And there's still a lot of stuff caught here, so that's not great. Mhm. 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 Just kind of looking around. What are people doing? Look at the indices. Yeah, Europe's kind of a mess right now with all those elections. So we look at the United States. Dow's the lagger. Russell benefits. Now, the market seems to interpret two cuts for some reason. I didn't really interpret it that way. And you're like, Wayne, how do you get to that conclusion? Well, if Russell's the biggest winner, they benefit the most from interest rate cuts. And so everyone's like, oh, they're going to cut soon. Okay, boom, Russell's up. Whoa, whoa, whoa. I read it like maybe two, but probably just one. That's how I read it. What I call 1.5 cuts. So, anyways, they're reading it too today. All right. I wonder how long that's going to last. I don't know. Maybe I'm wrong. Maybe it is two. Okay. If I remember this correctly, um, what was it? 8 people said one cut. And I think 11's no, two cuts. 11 said one cut. But as a group, but of the 11, I think it was 4 or 5 that said no cut, right? So 7 said one cut, 4 said no cut, 8 said 2 cuts, right? And so I'm like, "Oh, okay." So I'm like, "Huh, all right." So that's like one cut or none this year, right? And you're like, "Oh, okay." So that's how I kinda lean where, hmm. Let's take a look at the calendar. Interest rate decision out of Bank of Japan tonight. They don't schedule these things, they just come out, which is very strange for the Japanese, huh? Usually everything's like organized perfectly. What else? Weekly jobless claim, sure. PPI, all right, yeah, yeah, yeah. And you, Mitch, tomorrow. So last time 220 was forecast. We got 229. And then we'll get a new data set today, and then we'll add a red bar up here for the revision. So above 200 is what we're looking for. It looks like, so what would you say if we looked at the trend over the last 6 weeks or 12 weeks or something, what would that be? I guess this is 12 weeks, right? Week 12 to week 24. So this is 12 weeks. This is one quarter. And the average is 2, but it looks like we're pulling more like 220 right now. And 225 is the number. Yeah, that seems a little high compared to average. Now, in this case, a higher number means the employment industry is slowing down and the Fed could cut sooner than later. That's kind of thing. So bad news is good news. Those are pretty big numbers. You also want to look on the revision. Okay, does 229 get revised down? Okay, you want to look at that. Oil's still the biggest winner. It was significantly higher, huh? Wasn't this like 5% not long ago? Nasy's up almost 3, S&P 500 1 and a quarter. Biggest losers. Wow, amazing, huh? These metals. So this is telling us inflation is coming down. Inflation's coming down. That's what this says. You'd want to own those assets. Inflation were going up. So with inflation down yesterday, people are like, "That's it. That's over. Done." Think of it. What are they doing with their money? They're dumping gold, they're dumping copper, they're dumping platinum, they're dumping silver, and they're buying financial assets. You do the opposite with high inflation, you know. Right. So there you go. That's interesting. That there's a read. Like when you look at the numbers, you're reading the story of the market of what they're thinking. Mhm, mhm, mhm. Mm. So we approached 70 yesterday and then wimped out. Mhm, mhm, mhm. Just looking at that. Look at oil. Yeah, I'm still long oil. A little down to 77, then up after that. Probably bail. Look at yields. Oof. So fundamentally, this is still looking at the Fed as raising interest rates. It's not looking at it as them maybe cutting in the future, right? No, I did not, JP, but thank you for bringing that up. I appreciate it. Do you have any salt for my wound? Yeah, maybe margarita salt, it pink and blue. Yeah, to go in my festering wound. Yeah. It's still up from its original value. I'm still making money on it, but yeah, we'll see. We'll see how it goes today. But that's why I looked at it. I'm like, ugh, ugh. The trend is down technically. I'm like, ugh. All right, let's look at the S&P. How do you feel about that? Nice, just beautiful. Nice. Le fletto limon. But then we can go to like seasonality and we pull up okay. And the thing, and we talked about this at the CIA yesterday. And by the way, what an amazing meeting that was. Um, somewhere in this period, okay, somewhere in this period, the stock market rolls over. We had to make decisions for this time period. Okay. We had to make decisions going out to November. And so we made very conservative decisions yesterday after about 5 hours. 5 hours of meetings. It's really quite extraordinary. Really enjoyed the conversations and the thought processes and stuff. It was really cool. And so the thing is, our big discussion was it's easy to talk about the past, and that's what most investment committees do is they talk about the past and they pick investment strategies based on past performers. So they look at one strategy and it's not doing well. Fire them. And then there's one that's just doing great. So you put all the money there. Well, that doesn't predict the future, and you can really get caught always being late, choosing the winning horse after the race. And so, our prime focus is, well, if something like this happens in the future, and typically it does, what do we need to do now? Even though we're still like way over here. Yeah, well, that kind of stuff. Yes, it was chunky. It's up there. So, anyways, yeah, so it was difficult. We didn't have any losing investments. So, yeah, we had, you know, oh, yeah, it's there. What happened was it drops the newest one at the bottom. So then I go in and I rename it and then I drag it to the top. So now there's a part one and a part two, Shunky, and it's right at the top. So you'll see it now. You must have been up earlier than me. So, anyways, you see that. So that's what we got to deal with. But right now, there's still some up. I get really nervous, Nelly, around Canada Day, and that right in here, right? So, yeah. One thing we had talked about in that meeting is volatility. Look how steady this year was. Well, yeah, everything's horrible. Everything's great. Everything's horrible. Everything's great. Okay. But if you've hung around me for a while, you know I buy in this period and I buy in this period, so not too bad actually. But that April drop was really something. And again, back in April, the CIA, the Council of Investment Advisors, we moved money out of our most profitable yet riskier investments because we expected a possibility of a drop, and it dropped. And all we did was rotate out of like the one that is most sensitive to that drop, and it happened to be our most profitable. So we took profit, and then we just rotated it over. So that's what rotation means: is you take money out of a current investment and you move it over to a secondary one that was had a much lower beta, and that's what we did. And then it dropped, and then it recovered. Great, very interesting. But anyways, this is volatility, and it should return, you know, but this could be bad. Okay. So this could be, for example, how do you interpret this? This period here could be the stock market's coming down. And then October, November, December, the stock market going up. Because remember, the VIX has to do with um, investors buying insurance on their cash positions in the S&P 500. So if they're buying insurance, they're worried here, aren't they? Worried about what? It going up? No, they're not worried about it going up. The stock market, they don't care. They love it. You don't need insurance, right? So, but if they're buying insurance here, this is a period where they're worried the stock market might fall. And they don't want to bail on their cash positions. They're in it long term, so they'll just hedge. So this is hedging. And then around October, typically, and it's going to be different this year, by the way. Don't worry, I'll tell you. But nonetheless, what's typical is around this October period. What happens? Investors stop buying insurance on their S&P 500. Why? They're not worried. Why are they not worried? It's going up. Right. So, anyways, we the CIA is looking at making an investment into a VIX strategy, and but what we said, because we're right here, we said, yeah, we like it, but not now. We might do it over here. Cool, right? Isn't this nice? Boy, we have lots of information here. Lots of pretty colors for everyone's joy. Dollar flat is typical till August, and then dollar strength, dollar weakness. Notice the relationship. You're like, wait, what? If VIX, okay, if VIX is falling here and the dollar is falling, because this is dollar, but we just looked at VIX. Isn't there a relationship? Didn't you see VIX going up this time of year? And dollar gets strong there. So what happens? Well, if VIX is going up, and that's because the stock market's worried about the stock or about the market falling, or it is actually falling, that's a period in which the dollar is strong. And then if they dump their options to protect them, if they stop hedging around this period because the stock market is going up again, well, then you see the dollar weakening. You can see the relationship that we have going on. That's that's what I've been teaching, but now you can see that it's truth. Cool. So I think that's it. I'm out of a voice. So yeah, only a half an hour today. I apologize for that. But I hope you have a wonderful day. Today at 4 is the swing trading group at investorbootcamp.com. I hope to see you there. Maybe it'll be short and sweet. Yeah, who knows? But I wish you a wonderful trading day. I'll see you at forex.today at 9. Peace on earth. May the pips be with you. May you have a wonderful day. All right, cheers.